Good morning and welcome. My name is Teresa Campbell. I am with PIA Mid-America, and you have joined the Printing Industries Midwest and PIA Mid-America webinar on the second stimulus program. I am going to turn it over and introduce Steve Bonoff with Printing Industries Midwest. He's going to go through a few housekeeping items, and then we'll get ready to introduce our speakers and get started. Steve, thank you for joining us today.
Thank you, Teresa. Thank you, everyone, for joining us. Now, this call will be recorded, of course, for future listening. Wanted to talk through a couple housekeeping comments around how to interact on today's program. So there's two distinct ways to communicate to us. You have a chat function. We would appreciate your using the chat function to communicate any technical issues you might be having. There's going to be a lot of questions today. This is complicated work, and we know that we have well over 130 registrations for today. And I think that dictates that these are not going to be easy questions to answer. So please, as the topics evolve, you have a question, please put it into the Q&A. And when we get time to get to it towards the end, or if there is some type of a connection to a particular topic that we're in, we will address it at that time. We also have a number of panelists here from L.B. Carlson experts who will be answering questions along the way through that Q&A process. So please use the Q&A. We have our partners from L.B. Carlson, as always, in this joint meeting of Printing Industry Midwest and PIA Mid-America of our financial councils. And so we really want to thank Darren, Rick, and Rob for your expertise, and of course, Mel for your leadership throughout this entire trial. We hope this is going to be one of the last meetings we are going to need to have as it relates to COVID-19 funding. So whether that's true or not, I don't know, but there's obviously a lot of other topics that we're going to start to bring back into the financial discussion. And I think, Mel, you're going to address a little bit of that. So I'll turn it over to you. Thank you so much for being here and appreciate this time today.
Thanks, Steve. Appreciate that. I'm Mel Linger with L.B. Carlson. I'm also the co-chair of the Financial Executive Council, along with Ken Ryan from Daily Printing. So I'm just a couple of quick things. One, to welcome everybody and thank you for joining us today. Before I introduce the speakers today, I just want to mention from the Financial Executive Council, we are going to get together soon, and we've started talking about our schedule for 2021 and upcoming topics to discuss. As Steve mentioned, these past 9 months, it's been a lot of PPP and pandemic related items, which was necessary, of course, and there might be some more of that upcoming, but we do want to get back to other topics of interest to people. So we are going to try to put something out or publish something on our schedule for 2021 and drum up some new topics, some new ideas, and we'll probably be sending out a poll at some point just to see if people have anything they would like to be addressed. But you can also email any of us about some ideas you have or some suggestions. We'd actually really appreciate that. So now I'm just going to introduce the speakers today, which are three of my fellow partners at L.B. Carlson. We have Darren Cray, Rick Riesgraff, and Rob Yonkers. So I'll just turn it over to you guys.
Thanks, Mel. This is Rick Riesgraff. I'm going to start out today, give us a little introduction of what we're going to talk about, and then cover some things on PPP. So as I'm sure everybody on the call knows, in December, the long-awaited, I call it the third stimulus bill, the COVID relief bill, passed Congress after about a half a year of wrangling and back and forth, I think mostly for political purposes, but it got signed, and they call this, as a shortcut because the other name is way too long, the Economic Aid Act. So I'll be referring to that a lot in the context of our discussion. So Some of the key provisions of the Economic Aid Act included COVID support for certain industries and healthcare providers, the stimulus payments, of course, which is still getting a lot of dialogue and debate, unemployment assistance, and some additional loan support like EIDL loans, that type of thing. The things that we're going to talk about today are the last three items on the screen: the PPP funding and enhancements, payroll tax credit changes, and some tax law changes that were done to stimulate the economy and help us all out here. So I'll take the PPP. Rob Yonkers is going to talk about payroll tax credit, and Darren will come back and talk about some tax law changes, but I'm sure we're going to jump into each other's presentations. Hopefully we don't get too disruptive that way. So in terms of the PPP, the funding for PPP has been, I'd say, enormous. Pre-COVID, we couldn't have imagined numbers like this, but this is the third round. They passed $284 billion specifically allocated just toward PPP in this last act. So that's a total of $900+ billion allocated to this program. Not all of that second round got used, but it's still a big number. And I'm not sure we're going to see much more allocated, but we said that before too. So we'll just see what happens. So the SBA has issued their interim rules that interpreted what and how they're going to operate under the terms of the Economic Aid Act. All lenders, I believe as of yesterday or the day before, that are PPP authorized are now in queue and able to deal with these applications. And so things are set to go. And some of our clients I know have already submitting, and things are rocking and rolling right now. So some of the things I'm going to cover today on the PPP, there are some changes. Maybe next slide, Erica. The existing PPP loans, there's a chance to amend or tweak those. There's not a lot of changes, but I will go through those. There's a whole new first draw loan provision. So if you hadn't gotten a PPP loan before this, you still have an opportunity to do so. And then the big thing that we're going to talk about today is the second draw PPP loans. That's the ability, if you had a first one, you may have the ability to get a second one. So we'll go through that. A few other items, and then we're going to wrap it up with some discussion about loan necessity and some concerns that we have with that. So existing PPP loans. If you have not applied for forgiveness, you may have a chance to modify your loan, even though the covered periods have expired. There's been some changes in the new Economic Aid Act that they want to give you a chance to take advantage of. And so next slide. If you were a borrower of first PPP loans and you ended up giving some of that money back, you can reapply now up to the original amount, and using the current rules, which we're going to go through some of those as we talk here. So it might give you a little more chance to spend some of that money and get some, more forgiveness for part of the loan you paid back. We won't get into the rest of these too deep because they probably don't apply too much to our base on the call today, but partnerships, they redefined partner compensation and how you can apply that in the loan, so you have a chance to change your loan for that. There are some new expenses we'll go through in a minute that that qualify for use of proceeds now, and if you want to use those, you can talk to your lender about that. And if you're on the bubble in terms of the amount of forgiveness you're going to end up getting, and that helps you, you can probably do that. And then there's some provisions for farmers and ranchers, which I hope we don't have any of those on the call. Not because I'm against farmers or ranchers, but you'd be lost if you were on the call. So the initial PPP, I talked about new covered expenses. Initial PPP, we're all used to what those were. They were payroll, mortgage, interest, rents, that type of thing. They've added another bucket now, and I'll just go through these briefly. If you incurred expenses for business software on cloud computing that you needed in support of your operation because of COVID, It's a fairly loose definition, I think, that they have there. Those types of expenses will now qualify. Payments to essential suppliers connected with your operation can qualify if there was a contract entered into with that supplier prior to the start of your covered period. I haven't seen a lot of guidance on that, but the key there, I think, is this contract had to exist prior to the covered period. But I think if it did, and there's a supplier that's pretty key to your operations, you can include those costs now. Property damage related to damage caused by looting or riots, a new category, which unfortunately saw a lot of businesses impacted over the summer, fall, and just recently as yesterday, I see that's happening. And then lastly, the covered PPE costs, not PPP costs. That's personal protection equipment that you need to protect your workers, your customers. Those types of expenses will qualify now. So if you want to take another look at your existing PPP and see if the spend that you did on those items might cause you to get a greater forgiveness, you have a chance to maybe modify that initial loan. I'm changing gears now. I'm calling it initial loan, where the old PP, now this new first draw PPP is the PPP that is included in the $284 million additional funding. So most of who qualifies, it's still the same small businesses. So if you haven't got in line already, you still have one more chance to do it. Those are generally small businesses that are less than 500 employees that the SBA has defined as small business. They added a few other categories that hadn't been included before. Sole proprietors, 501c3s, 501c19s, and then special attention's being paid to NAICS code firms that are in the code 72. That would be accommodations, lodging, food services, restaurants, that type of thing. So those are getting special treatment for the first draw PP loans in this spending bill. The primary requirement to get this loan is that you have to attest that the loan is necessary for your continued operations. I think we're going to talk a lot about that a little bit later. So I think that's getting a little new scrutiny from the SBA as well as lawmakers. But you do have to need the loan. Important date here: the deadline for applying is March 31st. So it's not something you can wait till summer on. It's got to be done here in the next 90 days. And so other expense, Erica, can you move this slide? Other qualified expenses, we just went through that, are going to be very similar to what the initial PPP loans were. The same: payroll, mortgage, interest, rents, utilities, what these four new categories added to there. Next. The forgiveness terms are a little bit different. We're all used to either the 8 or 24-week covered period. Now you get the option to use anything in between. And if 10 weeks is good enough, you can stop collecting information and just submit your forgiveness application. So they've given you some flexibility on that. The amount of the loan is determined by the 2.5 times your monthly payroll. If I'll say you're a normal company, not in that 72 NAICS code. If you're in that category, or a restaurant or a hotel, you get to use 3.5 times your average monthly payroll to determine the loan size. But no matter what, that maximum loan on the first draw loans is still set at $10 million. So the Act authorizes a second draw PPP loan, and I think that's the one that's getting most attention right now. That loan has the same deadline. It's slightly different conditions, though. Certainly the loan necessity to sustain operations is the first primary factor, but now they changed the definitions on this to 300 or fewer employees. So if you're at 350, you automatically are not going to qualify for a second PPP loan. Another condition in order to get the loan is that you have used or will use the full amount of your initial PPP loan on eligible expenses before the expected funding date of the second PPP loan disbursement. That's a mouthful, but it basically means you have to somehow demonstrate that you used it all up. And I'll come back to that in a little bit when we talk about lenders and how they're looking at that. And then a very key factor in whether you qualify for a second draw PPP loan is that you've experienced a revenue reduction of 25% or more in all of 2020 compared to 2019 or in part of that year. And so there's two primary ways that they're going to look at that. One is that you can demonstrate that 25% reduction in gross receipts by comparing any calendar quarter of 2020 to the same calendar quarter of 2019. If you're down 25%, you can use that to help you qualify. Or if you know for a fact the total year of 20 was down by 25% or more of 19, you can demonstrate that you qualify that way. Next slide. The gross receipts that they're talking about here, it's not a complicated definition, but it's a very fluid definition. I think it's important to note that they're going to generally follow what they've used always to define gross receipts, and so but there's a lot of wiggle room in there. If you're a cash basis taxpayer and that's how you report your revenue, you're going to still have to be a cash basis taxpayer both in 19 and 20 when you do that. They want apples and apples comparisons. If you're accrual basis, the same factors that went in to defining your revenue in 19 should be used in 2020. The loan forgiveness of a prior PPP loan is not going to be included in gross receipts. So make sure you don't do that or you'll maybe never qualify. So the definition of gross receipts is pretty standard. Looking at your financial statements, what is that? And is it down 25% or not? And that's how you're going to know if you have a chance to qualify for this loan or not. We then ask, how do we substantiate that? And they've given us some guidance on that. There's many ways, and I don't think they're all out there yet even, but certainly if your tax return can demonstrate a 25% reduction from the prior year, you could give them the 2020 tax return along with 19, and that would demonstrate that you have declined by that much. Interim financial statements, comparable financials for maybe first quarter of 20 compared to first quarter of 19, that would work. Darren, you were just telling me yesterday that a couple of your clients are just using an Excel spreadsheet to lay out the gross receipts from one period to the next, or there could be other ways to substantiate that, but I think it's key that you do have to substantiate that. The loan amount is different, the maximum here in the second round. The $10 million drops down to $2 million as a maximum loan. There are slight changes that are beneficial to you trying to calculate that average monthly payroll, the 2.5 times average monthly payroll. It used to be a pretty rigid definition. They've given you some flexibility on how to define that and what period to pick that from. And then, as I mentioned before, the NAICS code 72 companies can use 3.5 times the average monthly payroll that can drive the loan amount. But in any event, it can't be more than $2 million. Erica? Okay. The applications are out now. They're going to be very similar to the initial PPP loans. There's one difference though. Loans over 150,000, you're going to have to submit proof of that 25% decrease in gross receipts with the loan application to your lender. Loans under 150,000 don't have to submit the proof with the application. But you're required to keep the support for that 25% decline, And I saw something mentioned that that may come back to get reported in a forgiveness application when you get to that. So make sure that the documentation is there for both of your loans over 150 or under 150 for that 25% decrease in revenues. So that's all I had on the second PPP. I don't know, Kristen, if there's any questions out there related to that. It's a great opportunity for companies, particularly the ones that are still struggling, to try and get another round of aid to help with the ongoing revenue shortfalls that some companies are still facing in this pandemic. So,
no question yet, Rick.
Okay, good.
Hey, Rick, if I can just jump in for a quick comment.
Sure.
I think it's important to know that you can apply for the second PPP loan, even if your first loan has not been forgiven formally by the SBA. But I will tell you that some banks are not allowing clients or customers to apply for the second loan until it's forgiven. And I just say that because I ran into that with a local bank yesterday with a client where they got notice back saying that their second loan will not be processed until their first loan is formally forgiven.
I had that in here later, Darren, but yeah, that's exactly right. That's not a requirement of the SBA or the bill, but they've given latitude with the lenders that if the lenders want that to happen, then that's what's going to happen. So you have to pay attention to it. So, probably one of the biggest items that was contained in the Economic Aid Act is the clarification of the tax impact of the PPP loans. For months now, we've been telling you that the IRS has been contending that the PPP loans would be taxable as they were going to disallow the deduction for expenses related to those loans. We were also telling you during that time that that was in conflict with the language that was in the initial CARES Act. There wasn't a lot of confidence that, actually, I think, Darren, you lost the bet on this, didn't you? There wasn't a lot of confidence that the IRS would get overruled, but in this last bill, the Economic Aid Act, they did overrule the IRS position. They flat out said the IRS can't do that. So PPP loans are going to be tax-free. And so that's a major cash impact to all the companies that had PPP loans. And so, but there are some issues with that, some tax basis issues. And then we say the federal tax is going to be tax-free, but we don't necessarily know how all the states are going to handle that. And so I was going to turn over to Rob for a minute, if you could talk a little bit about this tax basis issue and some of that state conformity as it relates to this tax-free PPP.
Sure, absolutely. Just a quick note on what basis is. So this is really for our friends out there that are S corporations and partnerships. Your basis is basically what you invested in your company. And then each year, your basis is going to fluctuate based on income, taxable income that you generate, or distributions that you take out of the company. So this is a good thing, though. Basically, what the IRS is doing here, what the Treasury is doing, is they're letting you increase your investment in your company by this PPP loan forgiveness. It's important to note that that basis increase will be in the year that you actually receive, I guess I would say, the notification certificate. I'm not exactly sure what that form is called, but for those of you who have already received forgiveness, you receive a letter from the SBA that says that your loan has been forgiven. And that will happen in the year that you actually receive, or the basis increase will happen actually in the year that you receive that letter, that certificate from the SBA. Erica, would you mind moving ahead to the next slide? Thanks. Here's just an example of what we mean by basis. And I guess one other thing to note, if your accountant, CPA, tax person has never talked to you about basis, maybe you have lots of basis in your S corporation, maybe you have lots of basis in your partnership, and this isn't necessarily an issue. But if they've said things to you like suspended losses, distributions in excess of basis, things like that, you want to pay attention to this example here. And in this example, we're just kind of showing you the timing issue here. Basically, we've got somebody who, not a very big company, but had $100,000 of gross receipts, $200,000 of expenses, and generated this $100,000 loss. And their investment in their S corporation or partnership prior to this year happening was zero. Well, if they're lucky enough to receive that forgiveness in 2020, or I don't know if lucky is the word, if they were aggressive enough to quickly file for forgiveness, and they received that certificate from the SBA in 2020, then they would get that increase in basis and they'd be able to deduct that $100,000 loss in 2020. And then the flip side of this is that if that happens in 2021, then that loss that incurred in 2020, if you're an S corporation, is suspended, and you'll get that basis adjustment next year. And assuming that everything is, you know, all the same next year, your gross receipts next year and your expenses are the same, that $100,000 loss next year will be released, and you'll get to take that against income in that particular year. And I did say S corporations, you know, partnership basis issues can be slightly different. This is really just meant for you to probably talk to somebody if you think you have basis issues, to see what might be happening from you in the current tax year. Next slide, please, Erica. Yeah, one other issue with this basis is just distribution issues. And again, I would say if you're an S corporation and you've always been an S corporation, then you shouldn't have any issues with the timing on this PPP loan and forgiveness. I mean, you still could have, I think Darren mentioned to me when he was reviewing the slides, that does not automatically mean that if you took a distribution this year that you couldn't have a distribution in excess of basis issue, which is maybe getting a little too deep in the weeds. But what this is really meant to talk about is those of you who are S corporations who used to be C corporations. When you were a C corporation, if you had earnings that are what's called accumulated earnings and profits, those sit in your S corporation and can become taxable based on when you take out distributions. Let me see what else is on this slide. Yeah, Erica, why don't you move ahead to the next slide? So this is just, again, an example of what AE&P means. And again, this AE&P concept is for you S corporations that were previously C corporations. Again, if you've always been an S corporation, probably not an issue for you. But in this case, we've got a company that has $25,000 of AAA. And again, I don't want you guys to get hung up on what all these acronyms and stuff are, but that is basically your S corporation taxable retained earnings. So that AAA number there, that's the amount that somebody can take out of a company tax-free. And in this case, we have a $100,000 distribution that the company took out. And what happens is there's certain ordering rules into which you have to take money out of your company under these different acronyms here, your AAA, your AE&P, and then I'll talk about in a second what this OAA is. So in this case, $25,000 comes out of your company tax-free. The next $50,000 comes out of AE&P, and then after that, $25,000 is coming out of your OAA. So in this case, if you weren't aware of these rules and you just took the money out of the company without talking to your tax accountant, you could have a little surprise there, because that $50,000 that you thought would be coming out tax-free actually would be taxed as a dividend on your individual income tax returns. So one other thing here, you can see that the PPP forgiveness, we're putting that over in what's called OAA. AAA is typically supposed to record items that are of taxable income or taxable loss in nature. Your OAA is for items that are tax exempt. This PPP loan forgiveness is going to be tax exempt. So that's why it falls over in that column. And again, there's certain orders that you have to take this out of, and so that has an impact on that. There is still, I'm going to say we're either waiting for some guidance or we're going to have to make some decisions on our own as to what we should do with the expenses that were submitted for forgiveness. I've seen some discussion out on the internet and some things that I've read where people think that perhaps the expenses related to forgiveness can also go in the OAA column, meaning that we could maybe net that to zero. Again, I don't know if that's the case because ordinarily those expenses are tax deductible. So we'll kind of have to wait for a little bit of guidance on that probably before we can give you a definitive answer. Next slide, please, Erica. Yeah, and just a quick note. I mean, I think I focused mostly on S corporations, but partners and partnerships, you could have similar issues with the timing of when you receive this basis for your PPP loan forgiveness. And that's, I think we'll turn it back over to Rick, unless there's any questions that popped up out there on this issue.
Rob, can you speak to the issue of state conformity?
Oh, yeah, sorry, I forgot about that. Yeah, I mean, state conformity, I mean, okay, here in Minnesota, our state does not automatically conform with federal rules. I know right across the border in Wisconsin, they do comply. So basically, and each of you are going to have to look to your state and see, okay, in my state, are we an automatically conforming state, or does our legislature need to do something for us to conform with federal law? So right now, if I'm a Wisconsin printer and this PPP loan was forgiven, on the federal side, it's not taxable. And in Wisconsin, it's also not taxable. As it sits right now in Minnesota, it's not taxable on the federal side. And in Minnesota, it is taxable right now. So we're waiting for our state legislature to notify us one way or the other. Thus far, they've been silent on the issue. So
each state would have to look and get guidance on that. And so look to your tax professional to get an answer, I guess, right?
Interesting. I just saw, I saw a note just popped up from a panelist that Wisconsin is also taxing the PPP loans. So I maybe I misspoke. I thought Wisconsin was a automatically conforming state. So maybe they've issued something separate saying that they're going to actually tax this.
You guys do have a couple of questions. Rob, I think this one's for you. How does an acquisition, which might affect the 25% threshold year over year, get calculated? Can we drop the acquired sales out of our 2020 numbers if they were not in 2019? Which I thought that was an interesting question about acquisitions.
I'll take a shot at that, and you guys can agree or disagree with me. But I don't think that I've seen any guidance to allow you to take that out of the definition of gross receipts year over year. We had a similar situation, not so much with an acquisition, but we had a printer with a one-time $10 million order in their one of their quarters, and they were also trying to take that out. The provisions don't allow for that, so unless additional guidance comes, we're assuming that it's quarter to quarter as it's reported.
Yeah, I agree, Rick. And just to follow up, I had that same question, and I followed up with a couple of bankers locally just to bounce it off of them, and their conclusion is the same, as it's not addressed in the law. So it's your sales as they are. Doesn't matter if you had an acquisition or sale of a portion of business or whatever. It's just 25% year over year.
Now, having said that, as the initial PPP went down and came out, the hundreds of things that had to get clarified later, it's quite possible that something like this could get clarified later. So we will always be trying to give updates on things like this. But I just know they didn't get it all right in what they did with their interim rules here in the first week of January. So there'll probably be some clarification. So stay tuned, I guess.
There's also a question, Rick, about second draw and work share. Do you have to take employees back to 40 hours if you're going to still continue to participate in work share on a second draw?
Yeah, there are different participation rules I would think for work share and what the PPP measures. Again, the PPP is going to measure hours worked. Doesn't matter necessarily. I think anyway, doesn't matter if there's another support program out there. I don't know, Darren or Rob, if you could weigh in on that. But
I mean, I think you're correct, and it's going to still come down to those dollars and then your FTE calculation when you get to forgiveness as well.
Right. You might have to take a look at which, as we've seen with the the initial PPP loans, though when they went to the 24-week covered period, those FTE reductions had to be pretty substantial before they were endangering forgiveness on a lot of our borrowers or a lot of our clients. So you might want to take a look and run the numbers, and it might not matter much on your PPP, and so you'd stay fully into that program. So you'd have to look at your circumstances.
Okay, thanks. And then just one more before you guys move on from this is, with the expanded definition of eligible expenses, does that apply to anybody's loan from last year?
Yeah, my understanding is it can. I don't know. Again, you'd have to run the numbers to see. Most of our borrowers, our clients, have not even bothered to use the other expenses, the outside of payroll, because you're not required to use them if you don't have to for the loan. So just because they've added another category, you may not have to use them to change your forgiveness. But I think that option is there now because they've kind of, all the PPPs, except for the second PPP, has different rules than the other PPPs, but all the PPPs are the same now. So I think you could, if you're on the bubble with forgiveness, that's what I said earlier, if you're on the bubble and those things help you, you can put them in the bucket.
Yeah, and I would add, I'm going to talk a little bit about employee retention tax credits, but there is a reason now why you might want to shorten your period if you could. So, and it is, I do agree with Rick. It's my understanding that these new expenses are all eligible for the first PPP loan forgiveness. Now, if you've already sent in your application, it's my understanding you're probably kind of out of luck. But if you haven't applied for them yet, and again, we'll talk a little bit more about this later, and you may possibly be eligible for some of these employee retention tax credits. It might make sense to grab some of these, but it's going to be a pretty limited circumstance.
Okay. Erica, next slide, I'll take it back. Just a couple other quick things to mention. In the initial PPP loans, a lot of borrowers got what was called the EIDL advance, $10,000 free money, it was called, earlier in 2020. And the PPP rules said that your forgiveness had to be reduced by that $10,000. The new Economic Aid Act has said, no, we're not going to make you do that. But the way they're going to do it is going to be, you don't change the application for forgiveness. You don't change anything that is already there. So you are going to get your forgiveness reduced by $10,000 in the initial application process. But what the SBA is going to do is remit what they call a reconciliation payment back to your lender, and then your lender is going to give you that $10,000 back. So if you did that and you had your forgiveness reduced by that $10,000, make sure you stay close to your lender, because at some point they're going to get the money and they owe it back to you. Here's the point that Darren just mentioned under lenders that I was going to make too, Darren, is that requirement of forgiveness applications be submitted before a second PPP. So we've covered that. So I'll just move on to the next slide. I wanted to talk a little bit about a loan necessity. The initial PPP loans required that you had to say you needed the money. The new first draw loans and the second PPP loans that are in the new Economic Act are also talking about the loan necessity provisions, and I think they're getting more attention this time around than they did even in the first round. So I want to talk about this because we have some concerns, but they're unfounded at the present time, but we just want to make sure that people are aware of what might be happening. So like I said, the certification of the loan, because you needed it to sustain operations, has been there for all the loans and will continue to be there. What they did in the first, the initial PPP loans, they came out and said, we understand that you guys don't even know what that means and you don't even know what you're up against. So we're going to give anybody that borrowed money under $2 million good faith safe harbor, meaning that if you had a loan necessity attestation that you made and said, yes, I need this loan, that you made that in good faith. And I think what they mean is we don't know what the future is going to hold. We think we're going to need this. We need this money, so we need to borrow this money. Loans under $150,000, they ended up eventually saying, we're not even going to look at loans that small, whether they needed the money or not. So the SBA won't be reviewing any of that necessity question for loans under that amount. For loans over $2 million, you are required to prove you needed the loan, and that will be reviewed in the required review of those loans. We've already seen questionnaires that our clients that have had loans over $2 million have had to fill out. And we know that that's going to be a key review item in the SBA audits. And I'll get into the guidance of what that means in the meantime. So it's really the middle category that I wanted to make a point on here, the loans from $150 to $2 million. They said they gave us a good faith safe harbor on making that loan necessity representation. So we would take that to mean that you certainly would never be prosecuted for fraud or for taking out the loan when you didn't need it or something like that. We're just not sure what it's going to mean when the SBA does a review on a random basis for those loans in that $150 to $2 million category. Do they still get to challenge your necessity assertion or not? And so it's a little clear as mud right now on that. So next slide, Erica. And on the second PPP loan, we've seen more focus on this need question than before. And so we are strongly urging that if you don't need this loan and really can't sustain it, the need through an exercise of financial proof, our advice is not to take this second loan, or it may cause potential problems beyond just even having to pay back the loan, because I just don't know how this review is going to take place. And the problem is it's got 6 years to run, because the SBA has 6 years to be reviewing loans. So I don't want to scream fire here, but it is something that we're concerned about. And I just wanted to share some language in the next slides, Erica. Some language that's recently come out that kind of shows the SBA is posturing to do something here. There was something that they published just recently called myth or fact sheet. And I think the PPP program, the SBA, has come under a lot of flack from certain contingents about, getting money when you didn't need it. And, you all have seen the bad publicity and that type of thing. So they're trying to do a PR job and telling the public on how they're going to police this. And this little blurb was included in their myth or fact sheet. It says, to ensure all program rules were followed, all loans are undergoing an automated review. So that's the software review. That, if something turns up goofy in your numbers because of the software review, you may get additional inquiries. Then all loans over $2 million are going to for sure undergo a manual review. So that's a requirement in the law, and that's what they're going to do. And then it says, in addition, any loan may be selected for a manual review. So I read that to mean any loan can get a review if they see something they don't like. So, and then they emphasize the SBA has a robust process for ensuring PPP funds were used as intended. And so I'm stretching that a little bit to go, well, use as intended means, does that mean the good faith assertion that you needed the loan for your operations in the first place? I don't know. So we can go to the next one. This one gets even a little more specific. The SBA, during the many, many months that we've been trying to figure out how this all works, have continued to issue frequently asked questions. So this was frequently asked question number 46, and I just took part of it. SBA has previously stated that all PPP loans in excess of $2 million and other PPP loans as appropriate, that's kind of a key little phrase, will be subject to review by SBA for compliance with program requirements set forth in the PPP interim final rules and in the borrower application form. If the SBA determines in the course of its review that a borrower lacked an adequate basis for the required certification concerning the necessity for a loan request, SBA will seek repayment of the outstanding loan balance and will inform the lender and the borrower that the borrower is not eligible for loan forgiveness. So at a minimum, they would make you pay it back if they don't agree with that you really needed the loan. So if the borrower repays the loan after receiving that notice, they will not pursue administrative enforcement or referrals to other agencies based on this determination with respect to that certification. So it implies even that they may go beyond just getting the money back. They would actually refer you to who? I don't know. They don't say. The IRS, I don't know. But so it's a fairly serious issue on this loan necessity. Now think back to last March, last April, last February, the sky was falling for many of us and everybody was having some very adverse consequences. I think it's a lot easier to demonstrate back then that we all thought if we took this loan, we absolutely needed it. And to lay out your case accordingly. We have a number of clients that have come through this thing and ended up in a better situation than they thought they would. And now looking forward are not nearly as wigged out today as they would have been, back last March. And so that necessity question, moves around a little bit. And so that's why we're saying be careful, particularly on this second PPP loan, because I think the IRS is going to look at it a little differently today than they did 9 months ago at a minimum. So next slide. So our recommendation is this PPP draw on the second loan. Don't take it if you don't need it. But if you do need it and take it, make sure that you build your file on the need assessment here or need assertions and make sure that you have a strong file because it will help you later. So I don't want to overplay that issue, but I just wanted to mention it. So that's all I had on PPP. And so I'm going to turn it over to Rob to talk about the retention credit.
So Rick, one thing I was just going to mention at the end about the PPP is that all that information is public too. So your customers can see that, your vendors, your neighbor, I mean, whoever. So, if I don't know if that deters or encourages anybody to take a loan or not, but just wanted to make sure to mention that. So
yeah, we've talked about that in
previous.
Yep.
Yeah. Okay. Well, all right, we'll move on and talk about the employee retention tax credit. You've probably heard of this, and perhaps you maybe even reached out to your CPA firm sometime after the pandemic and said, hey, what about the employee retention tax credit? And they said, well, if you took a PPP loan, you're not eligible. And that was true. And I know I said that same thing to several of my clients. Well, with the passing of the Economic Aid Act, they actually changed those rules. And now the employee retention tax credit can come into play, and it might be another source of cash potentially for you. For 2020, and this is, I think earlier I mentioned that it might be a fairly tough hurdle to get over. For 2020, to qualify for the employee retention tax credit, you would have had to have a quarter-over-quarter year where you had a 50% greater reduction in gross receipts when compared to the same year last year. So, let's just say we'll use March for example, and I think I have some examples probably later on. But if we use, it started in March, well, we can't use March, April, and May because those are maybe our 3 worst months, and compare those. We actually have to use a calendar quarter. So we'd have to actually pick the second quarter most likely to see if something like that happened. But if you do exceed that greater than 50%, then you are eligible for the employee retention tax credit. And we'll talk a little bit more about some of the other qualifications in a minute. Applies to wages after March after March 12th of 2020. And then this is where this might come into play more, the employee retention tax credit. Again, as part of the Economic Aid Act, they said for 2021, they made this credit available for the first 2 quarters. And you're eligible if you have a 20% or greater reduction in gross receipts for a calendar quarter in 2021 when compared to the same quarter for 2019. And again, it is 2019. I think the other day when we were prepping for this, I might have misspoke because I know Darren and Rick had a question on this, but it's definitely 2019. And I think what they're trying to do is give you the ability to look at your business pre-pandemic, because the first quarter of 2020 would have still had some effects of the pandemic probably in it. So next slide, please. And this is just the definition of gross receipts. And I think it's very similar to the definition of gross receipts that you would have for the PPP loan. You know, I guess I got a little technical here in, you know, reference code section 448C. And basically, you just need to use the whatever gross receipts you're using on your tax return. You need to use those gross receipts for measuring your periods to see if you had a greater than 50% reduction if you're looking at 2020, or a greater than 25% reduction if you're looking at 2021. Next slide, please. Okay, so here's the changes that happened to the 2020 credit. Like I said, you may have called and asked about this credit and been shot down unceremoniously. Now you can call back and say, hey, I learned now that I can actually take this employee retention tax credit if I had a PPP loan. One important thing is you cannot use the payroll wages that you're using for PPP loan forgiveness and double dip and use those for the employee retention tax credit. So just a few minutes ago, when Rick was talking about the PPP loans, I mentioned that if you hadn't filed for forgiveness yet for 2020, you may want to shorten your period. In Rick's portion, he talked about how you don't have to pick 8 weeks or 24 weeks anymore. You can basically pick 8 or 24 or anything in between. So it is possible that you may want to shorten up your period so that you're eligible for this employee retention tax credit as well. Keeping in mind, again, that you have to have had a calendar year quarter where you had a greater than 50% reduction in gross receipts, which again is a pretty big hurdle. You can also include healthcare costs to claim the credit to get up to the amount that you can use to claim the credit. And for the 2020 credit, something that again is different than 2021, basically, if you had more than 100 employees for 2020, you had to be paying those employees to really do nothing. If they were providing any services to the company, they're not eligible for the employee retention tax credit. Now, if you have 100 or less employees, that's not necessarily the case. You're automatically eligible. For 2021, they changed that bar and said, okay, well, if you have 500 employees or more, you have to be paying your employees to do nothing. And if you have 500 or less, you're possibly eligible for this credit. So for 2020, the credit was capped at $5,000 per employee. For 2021, it's actually $7,000 per employee per quarter. So you can get up to $14,000 per employee credit for 2021. Next slide, please. All right, so now I have to take a second here and digress. I mean, if we're talking about PPP loans, employee retention tax credit, we have to talk about the fact that you've probably been sitting at home a lot. You've had to binge watch some TV shows. Well, you're going to see from some of these next slides that I've really gotten into Cobra Kai. Probably because, you know, I guess the Karate Kid movie came out when I was probably 13, 14 years old. And I've started watching Cobra Kai. I just got through all 3 seasons last night. If you haven't watched Cobra Kai, I'd highly recommend it. Now, I'm only going to recommend it for those people that don't mind some cheesy lines, but some funny lines, and you know, a little bit of drama at the same time, and a little bit of karate kicking and people getting bloody and beat up. So anyways, but as you can see here, we're going to look at that gross receipts test that I talked about. The reason why I mentioned that, because our company here is the LaRusso Auto Group in Cobra Kai. Danny LaRusso has become a affluent auto dealership owner. So anyways, here's our 2019 and 2020 gross receipts. And you can see we've got a big dip in the second quarter, and we've got a greater than 50% reduction. So we qualify for the employee retention tax credit. Now, the important thing to note is that even though our third quarter gross receipts are not 50% or greater, or 50% or greater reduction, they are a 20% or greater reduction. So once you qualify with that 50% quarter, you continue to qualify quarter over quarter until your gross receipts have not gone down by more than 20%. So that's what this illustration is for. Because if you look at the fourth quarter, we're finally back to where we're not down by 20% or greater, so we no longer qualify for the credit. So again, 2020 credit, you have to have a quarter over quarter measurement where your reduction in gross receipts is 50% or greater. You continue to get that until your gross receipts measured quarter over quarter are less than a 20% reduction. Next slide, please. Okay, and this is just kind of how the credit would work for 2020. So in this case, I'm looking at the third quarter, and what happened is we already took the credit for Danny and Amanda, that's Daniel's wife, in the second quarter, but we decided to hire Johnny in the third quarter. We're not going to pay Johnny very well because he's not a very good auto salesman yet, but his eligible wages at that $10,000 still generated a nice $5,000 credit for the LaRusso Auto Group. Next slide, please. Okay, as I previously stated, you can now claim that credit even if you received a PPP loan. And so, yeah, this is where that opportunity for that planning opportunity is if you haven't applied for your PPP loan forgiveness yet. If we look at, again, I'm going to think back to the LaRusso Auto Group. If let's just say that their PPP loan was issued April 15th, and let's just say they're able to do a 13-week period. So my 13 weeks, this isn't going to be exact, but I'm just going to say that takes them out to July the 5th. I know it's not perfect math, but for my example, we're going to say that takes them out to July 5th. Well, as you saw in my example back there, they qualified for the employee retention tax credit for the second and the third quarter. Well, by shortening up that period, really, we're just using those second quarter wages for our PPP loan forgiveness. And now we're able to take those third quarter wages that we're paying after July the 5th for that third quarter and use that to apply towards the employee retention tax credit. So just something that you want to keep in mind. And that same thing is out there for a 2021 PPP loan. So, you know, I think like Darren and Rick said earlier, and I did the same thing. When my clients were asking me about PPP loan forgiveness, I said, well, why wouldn't you pick the 24-week period, even if you've had a retention? Throw all of your payroll costs on there, and now your payroll costs, even if you've had a reduction in wages or you've had a reduction in FTEs, are so great that you easily cover your PPP loan. Well, in hindsight, obviously, because we probably told people that before December 27th, you know, that maybe was the wrong move. There's nothing we can do about that now, but I know I was telling most of my clients, hey, wait. And now if they have waited, if they have one of those, you know, quarters where they really had a bloodbath and the revenues were down by more than that, well, now there's a planning opportunity where we can shorten up that period and kind of get the best of both worlds here. So next slide, please. Okay, talked a little bit about this, but the Economic Aid Act extended that for the first 2 quarters of 2021. The threshold has gone down to 20%. And I guess I would be remiss if I didn't mention that you're also eligible if you were shut down by the government. Now, I think most of our audience, you guys were considered essential and you weren't shut down. But if you know other business owners that were, you can certainly mention this to them. As I mentioned before, the credit's $7,000 per quarter. And there is one interesting thing about the 2021 credit. They do allow you to look back to the immediately preceding quarter to see if you qualify. So I've got an example on the next slide where, again, we're using the LaRusso Auto Group. But you can, if you don't have to wait and look at 2021, you can actually look at your fourth quarter of 2020. And if your fourth quarter of 2020 wages were down by more than 20% when you compare those to your fourth quarter of 2019. And again, when I say fourth quarter, I mean fourth calendar quarter, not your fourth fiscal quarter. You automatically qualify then for the first quarter of 2021. So most of you can look right now, probably at your books, and see, do I qualify for 2021 or not? And I already know that. Next slide, please. Okay, now I'm just going to run through a few examples on 2021. And part of the reason why I'm doing this is because, again, the hurdle was pretty hard in 2021. It's not quite as, in 2020, it's not quite as difficult in 2021 with that 20% threshold. And then the other thing is, the credit in 2021 has just, it's just so much larger and can be so much beneficial to your business, as we'll see by looking at these examples. But this is just to see, you know, do they qualify or not? We didn't need to do the look back. You know, in both the first and second quarter of 2021, their gross receipts were greater than 20%, a greater than 20% reduction when compared to 2019, so they're eligible. You can see that continued into the third quarter, but third quarter's out right now. So unless, you know, the Biden administration comes out with something that extends this credit, for right now, we're just talking about those first two quarters. So you're not eligible for that third quarter or fourth. Next slide, please. Okay. So when I was doing my other example for 2020, I didn't have all of your employees from LaRusso Auto Group listed. So now we listed, you know, we've got the old Sensei John Kreese on there, and we've got a few of our other friends from Cobra Kai on here. One thing that I don't know if I mentioned this before or not, but if you look at this slide and you compare it to the 2020 slide, you'll also know that the percentage of eligible wages went from 50% to 70%. I think I may have forgot to mention that, although it may have been on the slide. So, so if you look here, you know, Daniel's has $14,000 of wages. Well, we're limited to a 70%. We're limited to a $7,000 maximum. So even though Danny had the eligible wages of $14,000, and quite frankly, I'm looking at my slide right now, and I'm not sure why that's not $100,000. So I think that probably should be $100,000 for Daniel and Amanda. I'm just noticing as I'm talking out loud here. No matter, the credit is limited to $7,000, whether it's just $14,000 or not. And that's kind of why I have the example of having Johnny and John Kreese on here at $10,000, because you can see just by paying $10,000, we're meeting that max credit. But as you look at the math here, we've got 7 employees. We've got a $38,500 credit that we have with just these 7 employees. So I mean, just think about how impactful this credit could be if you have 20 employees or 50 or 100 or anything like that. So next slide, please. Yeah, and I think this slide is just to demonstrate that again, we've got this and it's eligible for the first and the second quarter. So the bottom part of the slide, you can see what the total credit is for these first 2 quarters. And I don't believe I mentioned it all, but this credit actually goes on your Form 941s. That's where you're going to report that. So your quarterly payroll tax returns. So if you look back and you go, well, now I'm eligible for 2020, you would just go and amend your payroll tax returns for 2020, and you should be eligible then to get a refund. For 2021, again, you can put this on your quarterly payroll tax returns if you have the information timely enough to be able to do that. And again, it's a refundable credit. So if your credit exceeds all of your employer portion of your FICA and Medicare during 2021 or 2020, you're going to get a refund. Next slide, please. Let's see. Yeah, just a reminder, and I think I already mentioned this, but the same planning opportunity exists that existed for PPP round 1, meaning that, again, you'll want to, if you're getting the second round of PPP loan and you're eligible for this credit, you're certainly going to want to gather all of those other expenses that qualify for PPP loan forgiveness and try to shorten up that period to as short as possible so that you can maximize the amount of credit that you can also receive. Keeping in mind, yeah, one thing to keep in mind is that your wages need to be at least 60% of your forgiveness amount. So keep that in mind. So, and that, I believe, is the end of my discussion on the employee retention tax credit.
Hey, Robbie, I have 2 questions.
Yeah.
So when you said you can do a look back period into the fourth quarter of 2020, You can look back to make sure to see if you're eligible, but you cannot apply until your first quarter is done because it's based off your first quarter wages, correct?
Well, that's technically not correct. There is an advance credit out there. I did not mention that at this time because we haven't been issued any guidance on it. I mean, when you read all of the information on the employee retention tax credit, it does talk about that there is the ability to receive an advanced credit, but they haven't given us any information yet on how you would apply for that, what you could do for that. So I didn't mention that, but so technically that's not correct, but when we're going to get that guidance, I'm not sure. We're already, you know, almost through January. So I guess if we see it pretty soon, we certainly could shoot, you know, that could be maybe one of our blasts that we do to everybody where they'd see that that's available out there. And then you said you had more than one question, Darren. Do you have another?
Yeah, and my other question is just, you know, you've talked about the planning on the forgiveness. If you thought you were only going to qualify for this credit for the first quarter of 2021, would it make sense to not apply for PPP loan number 2 until sometime in March? Because I think Rick stated that you have till March 31st to apply for PPP loan number 2.
Sure. Yeah, I mean, that's probably an excellent point. Yeah, yeah. I mean, the only issue is if you're worried that the PPP monies are going to run out, right? I mean, if you're not concerned about that, and I don't think there's quite the I mean, number one, you have the 25% threshold you have to qualify. I guess what I'm getting at is first round PPP loans. I think I probably had every single one of my clients apply, you know, sans maybe 1 or 2. In this case, there's probably only, you know, a handful to half of them that even qualify. So yeah, absolutely. If you're not nervous about the PPP loan being out there, you have until March 31st to apply. So that certainly would be another good way to plan for this, just to pump the brakes and wait. If you know you're already eligible, and claim the employee retention tax credit on these amounts, and then use your PPP loan for second quarter, and then possibly into the third quarter if you need to go into that, you know, the longer week forgiveness period.
Rob, I jumped the gun on answering one of Karen's questions, and so I just want to get clarification for her. She asked, do both first and second quarter of 2021 need to have 20% reduction, or just one of the quarters in comparison to the same quarter in 2019?
Sure, not both. I mean, just one. But if the first quarter doesn't work and the second quarter does, then you can only do it for the second quarter. If the first quarter works and the second quarter does, then it's only for the first quarter. But yeah, it doesn't have to be both.
Well, I just wanted to mention, you know, with regard to worrying about whether the PPP money is going to run out, they do post that quite regularly on where they're at with that. So we've learned to watch that, and so you can pay attention to that too, deciding how you're going to implement that planning strategy.
Okay, Kristen, nobody's got any Cobra Kai questions out there?
Well, Rick already was commenting that Bill said, why in the world would LaRusso ever hire John Kreese? So,
well, that's a good point. He's probably watching.
I mean, it's a fair point. Yeah, it's a fair point.
Well, maybe because you're supposed to keep your enemies close, right? Your friends close, but your enemies closer. I don't know. So,
Darren, you better take over.
Yeah, this is going downhill fast, but we kind of risked that when we asked Rob to help.
Yep.
So, well, I just wanted to go over some of the tax provisions that I think are important that were included in either the CARES Act or the new Economic Aid Act. I mean, obviously, the items that have got the most appeal from our clients or the most news are the PPP loans. And the biggest thing that did come out of the Economic Aid Act from a tax standpoint was that the PPP loans are not going to be taxable anymore. But I think there are some other ones that we should be reviewing and know about as we prepare our 2020 tax returns and also, you know, plan for 2021. So the first one I have is it was part of the CARES Act, and I think it was just the government's attempt to get the charitable organizations some additional monies during these tough times because they just anticipated their contributions being reduced. So what they did is they put a provision in the law that now allows taxpayers to deduct $300 of charitable deductions, $600 if you're married filing jointly, above the line, I guess. And when I mean above the line, it means you don't have to itemize your deductions anymore. If you don't itemize your deductions, which I think is more common now since the tax change that does not allow the deductibility or more than $10,000 of state taxes to be deductible, more and more people are not itemizing. So this is just something I think we should all be aware of to make sure, number one, we're providing the information to our tax preparer so that they can include it. But also if it does make a difference in your charitable giving, that you will receive a tax deduction for those amounts above the line, and unlike in prior years. And another big one related to the charitable contributions, that there's no AGI limit for cash contributions. Historically, you've only been able to deduct 50% charitable contributions up to 50% of your adjusted gross income, and the remaining contributions would carry forward to future years for a period for 5 years. That law has changed where now, or not changed, but they've amended that for 2 years. Whereas if they are cash, you can actually offset all of your adjusted gross income with cash contributions. I think it's important to make note that, you know, gifts of appreciated property, you know, stocks and things like that, or gifts to a private foundation, you know, those restrictions still apply and do not cover or do not qualify for the 100% reduction of your adjusted gross income. And in the Economic Aid Act, these provisions were extended to include 2021 as well. So I think those are important for that. Another one that we've been working with our clients more on now is, especially with the fact that the PPP loan is not taxable, is this net operating loss carryback. I see a typo there. It should be loss, not loan. Carryback. And the CARES Act now allows that losses generated in 2019 and 2020 can be carried back, whereas under the TTJ Act in 2017, carryback of losses were not allowed. And one of the main reasons we're reviewing with this with our clients is it's a potential rate play. So not only is it just a, you know, bird in hand where I can carry back and get some cash, it also could be a permanent tax savings because of the difference in the tax rates in 2020, which the highest tax rate is 37%. But if you have a loss in 2020, you can carry that back to 2015, and the highest individual tax rates in 2015 were 39.6%. So, you know, you look and there's a 2.6% spread and you go, well, it's really not that much. Is it really worth it? But if you take it to a step further and remember back in 2015, we had what we called the DPAD deduction, which was basically a 9% deduction based on your US manufacturing income. And now we have the 20% QBI deduction. It actually makes the spread between the maximum individual rates on pass-through income quite significant. In 2015, the rate went from 37% to 36% if you take into account that from 39.6 to 36% if you take the DPAD deduction. And the top individual tax rate for pass-through activity that qualifies for QBI is 29.6. So 7.6% spread in your tax rates. You know, if you're carrying back, you know, $500,000 or $1 million because you made a large capital addition in the first quarter of 2020, or even any time in 2020, and now you choose to take bonus depreciation or Section 179, the amount of those deduction, or the value of those deductions in 2015 could be considerably more than they are in 2020 or going forward. So I think if you are going to have tax losses and you had, you know, significant taxable income in 2015, I think it's something that you should probably look at to see if not only is it cash in hand, but it's also, you know, true tax savings because of the interest or the tax rate play. Next slide, Erica. The temporary waiver of required minimum distributions. I think it's too late to do this one anymore, but I just think it's an important one to remember when we're doing our 2020 tax returns in case we're asked. The CARES Act did suspend the distributions for 2020. Those were kind of some of the individual provisions. Now on the corporate side, there's also a net operating loss provision that changed. And basically what that law was is that with the TTJ Act of 2017, corporations could no longer carry their losses back. They could only carry them forward. The CARES Act changes this to allow carrybacks. So if you had losses in 2018, 19, or 20, you can now carry these back up to 5 years. So it's not only something to look at if you're a C corporation and you have losses in the current year, you can also look back at 18 and 19 and see if there are losses that you can carry back to prior years as well. And, you know, one of the things with the TTJA Act is it did reduce the C Corp taxable income from 34% to 21%. So there might be even a rate play on this, as well as freeing up some cash from some taxes paid in those years. So not sure how many C corporations we have on the call, but I think it's a way to generate some cash and carry back those losses. Next one, Erica. And then another one for our pass-through entities is prior to the CARES Act, there was a limitation that you could only deduct $500,000 of your pass-through losses. The CARES Act actually changed that so that all of those losses can now be carried back. So if you had $750,000 of losses in 2019, only 500,000 of those were deductible on your individual tax return, and the 250 was basically suspended or carried forward to future periods. The CARES Act removed this limitation, and actually, and Rob, you can help me on this, but I think actually not only did it remove it, it basically eliminated it. So if you did have losses in excess of $500,000, I think you actually are supposed to go back and amend those returns to show that loss on your individual tax return.
That is correct.
Okay, that's what I thought, but just want to make sure. So if you did have losses, there is an amendment that needs to be done, but there's also an opportunity for maybe for you to free up taxes paid on other activities or other businesses that you had, or compensation. Another big corporate one is on the AMT credit refund. Previously, the AMT credit refund was to be, any AMT credit carry forwards were to be refunded over a period of 3 to 4 years. Because if you remember, the TTJ Act of 2017 eliminated AMT. So if there were C corporations that had AMT credit carry forwards, there was a mechanism to get 50% of those refunded over the next 3 or 4 years. The CARES Act basically made it so all these credit amounts are refundable immediately. So if you have AMT credit carry forwards from prior years, just make sure that you are reporting all of those credits as refundable on your 2020 tax return. Then there's a bunch of stuff under this deductible interest limitation 163J, basically where you were limited to deducting 30% of your tax EBITDA for interest expense. They increased that to 50% for 2019 under the CARES Act, except for partnerships where it's not available in 2019. This one's a pretty small one, but it's important to some people. A technical amendment regarding qualified improvement property. When they did the TTJA Act, in 17, there was, I think, an oversight, or most professionals think it was an oversight. They just corrected for that, basically saying qualified improvement property is now 15-year property. And the big thing about that is it's now allowable for bonus depreciation. So pretty narrow, but for some of our clients, it was a pretty big deal. One of the big ones, I think, that came out of the Economic Aid Act outside of the PPP loan guidance on taxability is obviously Congress is hoping to revitalize the restaurant industry. So for 2021 and 2022, they are allowing 100% deduction of business meals. So it's food or beverage that's provided by a restaurant, and they're allowing 100% deduction as long as it still qualifies under the old business expense rules, which basically means, you know, there has to be business performed. It can't be, you know, you and your buddy out for drinks. It's got to have a business purpose and business discussed, and you attend the meeting. But this one is a pretty significant one for a lot of people, especially when hopefully the restaurants get up to full capacity and we're be able to do these networking and business lunches again. For that to be 100% deductible for the next 2 years will provide a lot of tax savings for a lot of our clients.
Darren, that was usually 50%, right?
Yeah, I'm sorry. Yep. It was previously 50%.
Over the course of a year, that can add up to a big number.
Yep. I don't know if there was any questions on that part of it. And this last 2 slides, I guess, is not getting political or anything. But, you know, I think this is an area where there is going to be a lot of change in the future. Don't know if that's going to be near term in 2021, 2022. You can read as many articles as you want, and some of the articles say the change is going to happen tomorrow, and some of the changes aren't going to happen for 2 to 4 years, or you know, a lot of the provisions within the TTJA with the estate tax and the QBI and some of that stuff are set to sunset at the end of 2025 under current law. So I just kind of put from a tax planning side, I think this is just somewhere where, you know, as your accountants and as business owners, we got to maintain, keep an eye on. And it's, you know, there's change in administration, control of the Senate, and, you know, how are we going to pay for this stimulus? You know, I don't know how many $1 trillion it is already, but if you believe some of the stuff on the internet, there is going to be another $1.9 trillion package presented pretty early on in Biden's administration. So I just think there's going to be a lot of changes in the future, and probably a lot of opportunities for some tax planning that could be beneficial for people on this call. And what does this mean? And I talked about a little bit about reduction in the lifetime exemption. You know, that's currently the lifetime exemption is somewhere around 11.6, 11.7 million for every individual for what they pass on to their beneficiaries at death or during a lifetime, I guess, either gift or death. You know, is that going to stay where it is, or is that going to go back to the $5 million levels that it was prior to the TTJ Act, and to levels where it was under the Obama administration? QBI, is that going to stick around till 2025, or is that something that they'll get removed from the law, or at a minimum it does sunset in 2025, like I talked about, tax increases, and then just the sunset I talked about. So just things I think we all have to be thinking about going forward when we're looking at our business and individual income tax circumstances.
Oof.
I guess that's all I had. I don't know if Rob or Rick, you had anything to add?
No, just as usual, though, if there's any questions that come up after the fact, feel free to reach out to Steve or Teresa or any of us, and our contact information is there. Happy to try and answer things. Like Ed said.
Well, that was terrific. Just chock full of such valued information. I know everyone is walking away with Cobra Kai as probably the key takeaway, but beyond that, I think the rest of it was really good as well. I didn't know that Cobra Kai actually has a 93 on Rotten Tomatoes. So throwing that out there, it's not just wow.
Yeah, there you go. Exactly. It's a good show.
So that was really, I mean, no kidding, all kidding aside, that was an amazing amount of information. And for those, I'm sure, are going to need the recording to refer back. I know I found some of the explanations so confusing only because that I think the laws and so many instances are so confusing. So I'm sure people are going to need to be referring back to the tremendous information that you put through on that recording. So Teresa, any final words from you?
Just so incredibly informative. Thank you for taking the time to go through the depth that you did for our members on all levels. So you brought up some opportunities that I don't think everybody has been considering or thinking about, and we want to make sure that they take advantage of those opportunities. So again, it's complicated, and I'm sure they may have additional questions after this call that we will pass on to you. For those that are members that are on the call, the LB Carlson team is incredible. They often provide to us additional content. Watch our newsletters for that as new details and clarifications come out. And if there is a large amount, we'll ask for them to host another webinar. Thank you again. It is, again, informative and necessary information.
Thank you.
All right, thank you.
Thanks.
Well, thank you again. And we're, as we mentioned earlier in the broadcast, we will be meeting soon to discuss all the rest of the topics that will be coming out throughout the year. And we'll be getting communications and a poll out to you to make sure that we're addressing your needs in these meetings. So looking forward to seeing you again soon. And Mel and your team, again, thank you all for the support.
Thank you.
Thanks.
Thank you. Great job.